Hello everyone. Welcome to this Q&A session on module 2. So we have already completed module 2 wherein we learned about the taxpayer types and the registration process. So under this module we studied the different concepts like what are the different types of taxpayers: regular, composition, casual and non-resident taxable person. Then we took an overview of the GST portal and we learned about the document required for getting enrolled under GST. So, the basic documents that are required to get registered under GST. Then we also learned about the step-by-step process of registration process on the GST portal. Also, we learned about the amendments and cancellation of existing registrations. So now let us take up the questions, and in this Q&A session we will cover the entire topics that we have covered in module 2. So to begin with, first question: a small restaurant owner in Rajasthan with an annual turnover of rupees 80 lakhs is considering opting for composition scheme. Advise them on the benefits and limitations of this scheme compared to regular taxpayer. So first of all, we need to understand who are composition dealers. So those taxpayers whose turnover has not exceeded rupees 1.5 crores in the preceding financial year can opt for composition scheme. Under the composition scheme, they have to discharge their GST liability by paying certain percentage of their turnover as composition fee. In case of manufacturing and trading, this rate is 1%, and in case of services, this rate is 3% and 3% under each CGST and SGST head. Also, for restaurant services, there is a special rate that is 5%, 2.5% under each head. So, in context with this question, benefits of composition scheme: lower tax rates, typically 5% for restaurants, simplified compliance with quarterly return filing, Form GSTR CMP 08, and no need for detailed record keeping. So, the compliances are very simple. Only one return, that is CMP 08, is to be filed, wherein the total turnover achieved during the relevant quarter has to be disclosed, and GST at the rate of 1%, 6% or 5% in case of restaurant is to be discharged. Also, an annual return, that is GSTR 4, is to be filed with the GST department by the composition dealers. Then the limitations: the composition dealers cannot claim input tax credits, they cannot make interstate supplies, also they cannot supply goods through e-commerce operators and cannot issue tax invoices. So these are the limitations of composition scheme. Next, in context with this question, the recommendation is, if the restaurant primarily deals in intra-state supplies, and doesn't rely heavily on the input tax credit, for example, high input costs with minimal GST, and wants a simpler compliance regime, the composition scheme could be beneficial. However, if they plan to expand interstate or have significant ITC, the regular scheme is more suitable. So, since the turnover achieved by this restaurant is rupees 80 lakhs, it can opt for composition scheme, but other things must also be taken into consideration before applying for composition scheme. Moving ahead, what distinguishes a casual taxable person from a non-resident taxable person under GST, and what are their specific compliance requirements? So, in order to understand the difference between the casual taxable person and a non-resident taxable person, it is important to first understand the meaning of casual taxable person and non-resident taxable person. So an individual or entity making occasional taxable supplies in a state or union territory where they have no fixed place of business are the casual taxable person. So for example, a person willing to participate in a trade fair in another state where he doesn't have any fixed place of business during the festive season of Durga Puja. Such person is required to obtain registration as a casual taxable person. Then non-resident taxable person, an individual or entity with no fixed place of business or residence in India, occasionally supplying goods or services in the country. So those NRIs or those non-resident persons who are willing to supply goods or services within India are required to obtain GST registration as a NRTP if they do not have any fixed place of business or residence in India. So the key differences: casual taxable persons have a place of business in India but not necessarily in the state of occasional supply, while non-resident taxable persons have no residence or place of business in India. Casual taxable person can claim input tax credit on all inward supplies, whereas non-resident taxable person can only claim input tax credit on imported goods. So these are the key differences between a casual taxable person and a non-resident taxable person. Next we have compliance requirements for both. So mandatory registration regardless of turnover threshold, both the casual taxable person and the non-resident taxable person are required to obtain mandatory registration under GST with exceptions for specified handicraft goods for casual taxable person. Then they must obtain a temporary registration typically valid for 90 days which can further be extended to another 90 days and are required to deposit advance tax based on their estimated liability. So before executing any supplies, they are required to deposit the tax amount in advance by a reasonable degree of estimate of their expected supplies. Then casual taxable person file GSTR 1 and GSTR 3B while non-resident taxable person file GSTR 5. Neither can opt for composition scheme. So both of them are not eligible to obtain the registration as a composition dealer and they have to obtain a registration specifically as a casual taxable person or the non-resident taxable person. The casual taxable person have to file GSTR 1 on monthly or quarterly basis and GSTR 3B wherein the tax liability is discharged, whereas the non-resident taxable person are required to file GSTR 5 as a compliance requirement under GST. Moving to next question. An input service distributor receives a consolidated invoice for advertising services used by multiple branches in different states. Explain the purpose of an input service distributor and how it handles the distribution of input tax credit to its branches. So to answer this question, we have to first understand who are input service distributors. So an input service distributor is a business unit that receives invoices for input services and then distributes the input tax credit on these services to its different branches or units under the same PAN in proportion to their turnover. This mechanism ensures proper utilization of input tax credit when services are centrally procured but consumed by multiple locations. So let us understand this with a simple example. Imagine a company operating in multiple states within India with its branches in Bangalore and manufacturing facilities at different locations like Chennai, Mumbai or Kolkata. All these branches use a common software for their operations and annual software maintenance services, that is AMC services, invoice is issued in the name of corporate office in Bangalore. So As per the input tax credit rules, it can only be claimed by the registered person receiving the services. In this case, the invoice is in the name of Bangalore Corporate Office, but the software is used by all 4 locations. So if the Bangalore office were to claim the entire input tax credit, it wouldn't accurately reflect the utilization across the different branches, and other branches might not be able to utilize the credit against their output tax liability. So in this case, the Bangalore Corporate Office receives the invoices for software maintenance, including the applicable GST, either CGST, SGST or IGST on such services. Then it will distribute the input tax credit to its branches in Chennai, Mumbai and Kolkata in proportion to the services they utilized. This is done by issuing an input service distributor invoice to each branches, clearly indicating the amount of credit being allocated to each branch. Then branch utilizes this credit. So in this way, the input service distributor distributes the input tax credit against the services that has been procured centrally and later on distributed to the branches. So ITC distribution, the input service distribution issues an ISD invoice or a debit note to each recipient branch indicating the amount of credit being transferred. The distribution is typically based on the turnover of each unit in the previous financial year. The input service distributor is required to file GSTR 6 on a monthly basis, detailing the input tax credit received and distributed during the reporting period. So moving ahead. Question number 4. Identify the eligibility criteria for a business to be classified as a regular taxpayer under GST. And what are the key compliance obligations associated with this category? So a business or individual is classified as a regular taxpayer if their annual turnover exceeds the prescribed threshold, that is 40 lakhs in case of goods and 20 lakhs in case of services, with certain lower limits for special category of states. Also, they shouldn't have opted for composition scheme. Additionally, businesses involved in interstate supplies, e-commerce or those liable for reverse charge mechanism are typically regular taxpayer irrespective of their turnover achieved, except for specific exceptions like notified handicraft goods or services. So, such taxpayers whose turnover has exceeded the threshold limit of 40 lakhs or 20 lakhs as the case may be in case of goods or services, and those who have not opted for composition scheme are classified as regular taxpayers. Then the key compliance obligations. So regular taxpayers must issue tax invoices, collect GST from customers, claim input tax credit on their purchases, and file monthly or quarterly GST returns, that is GSTR 1 return, which shows the outward supplies made during the reporting period, and GSTR 3B, in which tax amount is paid, and an annual return, that is GSTR 9, along with a reconciliation statement in GSTR 9C, which is to be filed by those whose turnover has exceeded rupees 5 crores during the preceding financial year. So they are subject to detailed record keeping requirements also. So in case of regular taxpayers, these compliances are mandatory and there are certain timelines for each compliances. So moving ahead, a newly formed private limited company needs to register for GST. Detail the specific documents required, including those for the company and its director or signatories. So a private limited company is a separate legal entity in the eyes of law. It has separate PAN and incorporation documents, which is CIN, that is corporate identification number. Also, the director's PAN are different from the company's PAN. So in case GST registration is to be taken for the company, the list of documents that are required will be the company's PAN, then the certificate of incorporation, that is COI, then the memorandum of association and the articles of association. So the MOA contains the different clauses like capital clause, then object clause, etc., whereas the articles of association contains the rules and regulation for the internal management of the company. Then PAN and Aadhaar of the authorized signatory, those who are authorized to apply for GST registration and submit the documents on behalf of the company. Then proof of their appointment like appointment letters and the master data as generated from the Ministry of Corporate Affairs official website. Then PAN and address proof of all the directors. Since directors are the office bearers, so PAN and Aadhaar of all the directors are also required. Then photographs of directors and signatory. Photograph of directors and signatory are inserted in the registration certificate, that is GST registration certificate, and any amendment or modification in the directorship of the company needs to be communicated to the GST department for a change and a issuance of fresh GST registration certificate. Then company bank account details. These details can be furnished after the registration is obtained, but within 30 days from the effective date of registration. Then principal place of business address proof. It is very important document wherein a rent agreement or a no objection certificate or a consent letter along with utility bills like electricity bill or holding tax receipt are to be furnished. So these are the list of documents that are required to be submitted at the time of filing application for new registration for a private limited company. Next, during the GST registration process, an applicant chooses the Aadhaar authentication route. Describe the benefits of this method and the step-by-step process of using Aadhaar authentication on the GST portal. So what is an Aadhaar authentication route? At the time of filing of registration application and upon the final submission of the registration application, a link is sent to the registered email ID of the applicant or the authorized signatory, wherein the authorized signatory or the applicant has to open up this link and enter his Aadhaar number, upon which an OTP is sent to the mobile number that is linked with the Aadhaar. Once the OTP is verified, the Aadhaar authentication is successful. So this process ensures the genuineness of the registration application. So Aadhaar authentication streamlines GST registration by expediting verification. If an applicant opts for Aadhaar authentication during registration, they will receive an authentication link on their Aadhaar registered mobile number and email. By clicking the link, declaring and entering the Aadhaar number, an OTP is sent for verification. After successful OTP verification, the registration is processed. This can potentially shorten the approval time frame compared to needing a physical site verification if Aadhaar authentication is not chosen. So in case where Aadhaar authentication has not been opted by the applicant, then the department conducts a physical verification of the premises of the business. So moving ahead, a registered business wants to change its legal name without altering its PAN. Explain the process of amending this core field on the GST portal, including documents, requirements, and approval process. So to amend any particulars in the existing GST registration, there are two modes. One is amendment of core fields and another is amendment of non-core fields. So in case of core fields, the documents that are furnished along with the application for amending the core fields are thoroughly examined by the officers, and upon the satisfaction, a fresh registration certificate is granted. Whereas in case of non-core field amendments, the system approves it upfront. No major verification is conducted. So to change a legal name, that is a core field, without changing the PAN, a registered business must log into the GST portal and navigate to the Services tab. Under the Services tab, there is an option of registration. Under this registration, there is an option amendment of registration core fields. So now they will have to select the Business Details tab, edit the legal name and provide the date and reason for the change. Supporting documents such as certificate of incorporation or partnership deed must be uploaded along with the application. The application is then verified and submitted. The tax authorities will review the application and the documents. If they approve, an order under GST REG 15 is issued and the updated registration certificate is available for download. So this is the process of amending the core field. In case of non-core field amendment, the steps remains the same, but no major document submission is required. Moving ahead, a business registered under GST needs to cancel its registration due to the closure of operations. Explain the step-by-step process for a taxpayer initiated cancellation of GST registration on the portal, including the requirement for filing a final return. So to cancel an existing registration, the taxpayer must clear all the GST liabilities first, then he has to file a cancellation application and reverse any input tax credit that is appearing in the portal, file a stock statement, and then finally, once the registration application is accepted, a final return is to be filed. So to initiate GST registration cancellation due to business closure, a taxpayer must log into GST portal and submit an application in form GST REG 16. The application requires stating the reason for cancellation, the effective date of cancellation, and the details of stock value and associated tax liability or input tax credit reversals. After submission and verification, the tax officer reviews the application and issues a cancellation order in form GST REG 19 within 30 days. A mandatory final return in form GSTR 10 must be filed within 3 months of the cancellation order or date, whichever is later, detailing stock and liabilities up to cancellation to settle dues. Post cancellation, the business cannot collect GST or claim input tax credit and is exempt from regular GST returns. So this is the process of applying for cancellation of registration. So certain things must be kept in mind before applying for cancellation. Any pending notices or appeals or any other communication from the GST department must be first resolved, then only application for cancellation should be filed. So moving ahead, when providing bank account details during GST registration, what specific requirements need to be met for the supporting documents, particularly concerning format and content. So once a registration has been approved by the department, the taxpayer must update the bank details within 30 days from the date of approval of registration. So once the registration is approved, a bank details has to be updated in the registration. When submitting the bank account details for GST registration, the documents must be a copy of cancelled check or a bank statement extract showing the first and last pages. The file should be in JPG or PDF format with a maximum file size of 100 KBs. So any of the above requirements or these requirements, if not followed properly, will lead to a rejection of updation of bank account on the GST portal. Then we have question number 10. A business owner needs to change their mobile number and email ID registered with the GST portal. Describe the steps to update these non-core fields using the online amendment process. So we have just discussed about the amendment of core fields and non-core fields. So in this case, email ID and mobile number falls under the category of non-core fields. Here, to update a non-core field like mobile number and email ID, first we have to log into the GST portal and go to services. Under the services tab we have registrations. Under the registration we have amendment of registration non-core fields option. We have to choose this option. Then we have to edit the details in the promoter or partner or authorized signatory tab. Enter the new information, verify with the OTPs sent to the new contact detail and submit. Changes to non-core fields are auto approved by the system. So this is the process to update the email ID and phone number of an existing GST registration. So these are the questions pertaining to module 2. Now we'll move to module 3.